If you own gold bars right now, what I'm about to share could change everything about how you view your investment. Because while most people are celebrating recent gains, there's something happening behind the scenes that very few are talking about. And it's not what you think. Let me start with a question that should keep you up at night. Why are central banks around the world buying gold at the fastest pace we've seen in over half a century, while at the same time, mainstream financial media keeps telling everyday investors that gold is overvalued? Think about that for a second. The world's most sophisticated financial institutions, the ones with access to data and intelligence that you and I will never see, are accumulating physical gold like their lives depend on it. Meanwhile, retail investors are being told to stay away. Something doesn't add up, does it? Here's what's really happening. Gold just broke through all-time highs, shattering previous records, and entering territory that most analysts said was impossible just months ago. But this isn't your typical bull market rally. This is different. This is structural. And if you understand what's driving this move, you'll realize we're not at the end of this trend. We're at the beginning. Let me paint you a picture of what's unfolding right now in the gold market. Silver just cracked through $90 per ounce. Think about that. Silver, the metal that was trading in the teens not that long ago, is now approaching triple digits. Gold is hitting record after record, day after day. And here's the kicker. This isn't happening because of some temporary fear trade or a short-term flight to safety. This is happening because the entire global monetary system is being restructured right before our eyes. You see, most people look at gold as just another investment. They see the price going up and they think, oh, that's nice. My gold bars are worth more. But they're missing the bigger picture. They're missing what this price action is really telling us about the state of our financial system, about the future of the dollar, and about what's coming next for anyone who's trying to preserve wealth in this environment. Before we go any further, I want to make sure you have access to something I put together. There's a free guide in the description below that shows the saving secrets thousands of American retirees are using right now to protect their hard-earned wealth. It's completely free, and it could be exactly what you need to see right now. Check the description after we're done here. Now let me take you inside what's really driving this gold surge, and I'm going to show you why this is just the beginning of something much, much bigger. The first thing you need to understand is the supply and demand dynamics that are creating a perfect storm in the physical gold market. We're not talking about paper gold, the stuff that trades on exchanges and exists only as digital entries in a computer system. We're talking about actual physical metal, the kind you can hold in your hand, the kind that central banks are stockpiling. Here's a fact that should terrify anyone who doesn't own gold. Global gold mine production has been essentially flat for years. We're not finding major new deposits. The easy gold has already been mined. What's left is deeper, harder to extract, and more expensive to produce. Meanwhile, demand from central banks alone has increased by over 400% compared to historical averages. 400%. Let that sink in. But it gets even more interesting when you look at who's buying. It's not just any central banks. It's specifically the central banks of countries that have been vocal about moving away from dollar dependence. China, Russia, India, Turkey, Poland. These aren't random countries. These are nations that represent billions of people and trillions of dollars in economic activity. And they're all doing the same thing, converting their dollar reserves into physical gold. Why? Because they see what's coming. They understand that the dollar's role as the world's reserve currency is not guaranteed forever. They're watching the United States government add trillions to the national debt every single year. They're watching the Federal Reserve's balance sheet balloon to levels that would have been considered insane just a decade ago. And they're making a calculated decision. Get out of dollars. Get into gold. Now here's where it gets really fascinating. Let me tell you about something called the COMEX. It's the major exchange where gold futures are traded in the United States. And there's a ratio that sophisticated traders watch very closely. It's called the registered gold ratio. Essentially, it tells you how many ounces of paper gold claims exist for every ounce of actual physical gold sitting in COMEX vaults available for delivery. Want to guess what that ratio is right now? It's over 100 to 1 in some contract months. Think about what that means. For every single ounce of physical gold that could actually be delivered, there are over 100 ounces worth of paper claims. It's like a bank that has $1 in the vault, but has written $100 worth of checks. as long as everyone doesn't show up to cash their checks at the same time, the system works. But what happens when they do? This is what's known as a squeeze. And we're starting to see the early signs of it playing out right now. More and more investors are demanding physical delivery instead of just settling in cash. More and more people are saying, I don't want your paper promise, I want the actual metal. And the system is starting to crack under that pressure. Let me give you a historical parallel that might help you understand where we are right now. Go back to 1971. That's when President Nixon closed the gold window, ending the direct convertibility of dollars to gold. At that time, gold was $35 an ounce. Within 9 years, by 1980, gold had reached over $800 an ounce. That's a more than 20-fold increase. But here's what most people don't know about that period. The real gains didn't happen gradually over those 9 years. They happened in explosive bursts. Gold would consolidate for months, sometimes years, and then suddenly surge 50, 60, even 70% in a matter of weeks. The people who made life-changing wealth weren't the ones who tried to time every little move. They were the ones who understood the macro trend and held physical metal through the volatility. We're in a similar setup right now, except this time, the imbalances in the system are far greater. The debt levels are far higher. The geopolitical tensions are far more severe, and the number of people who understand what's happening is far smaller, which means the opportunity for those who do understand is far greater. Let me tell you about what's happening in the physical market right now that should concern every gold bar owner. There are reports coming out of major refineries in Switzerland, the heart of the global gold refining industry, that they're running at full capacity and still can't keep up with demand. Premiums for physical gold bars and coins are spiking. Delivery times are extending. This is not normal market behavior. This is what happens when there's a fundamental shortage developing. And here's the thing that should really get your attention. While all of this is happening in the physical market, the paper gold market is still trading like everything is fine. The futures market, the ETFs, the derivative products, they're all still functioning normally. But there's a growing disconnect between the paper price and what you actually have to pay to get your hands on physical metal. That spread is widening, and historically, when that spread widens, it's a warning sign that something is about to break. Think about it like this. Imagine you're at a bank and you notice that the ATM withdrawal limit keeps getting lower and lower. First it's $500 a day, then $300, then $100. The bank keeps telling you everything is fine, your account balance hasn't changed, but you can't actually access your money. Would you feel comfortable? Would you trust that bank? That's essentially what's happening in the gold market right now. The paper claims say one thing, but the physical reality is telling a very different story. Now let's talk about what this means for you if you own gold bars. First, the good news. You're ahead of the curve. You already understand that physical gold is real wealth preservation. You're not relying on someone else's promise. You're not dependent on a financial institution's solvency. You own actual metal. That puts you in a very different position than the vast majority of people. But here's what you need to understand about the current environment. The rules of the game are changing. We're moving from a period where gold was seen as a fringe investment, something for doomsday preppers and conspiracy theorists, to a period where gold is being recognized as essential monetary insurance by the world's largest and most sophisticated institutions. That shift in perception is going to drive prices far higher than most people think is possible. Let me share something with you that might sound controversial, but I believe it's true. The current price of gold, even at these record highs, is still dramatically undervalued relative to the amount of currency that's been created over the past 15 years. If you adjust gold for the expansion of the money supply since the 2008 financial crisis, we should be seeing prices significantly higher than where we are now. The fact that we're not there yet tells me there's still a massive amount of upside potential. But here's where it gets tricky. And this is important for anyone who owns physical gold to understand. As this trend continues, as more people wake up to what's happening, as the squeeze in the physical market intensifies, you're going to see increased government attention on gold ownership. History shows us that when monetary systems come under stress, governments often try to control or restrict gold ownership. It happened in the United States in 1933. It's happened in other countries at various times throughout history. I'm not saying it will definitely happen again, but it's something you need to be aware of and plan for. This is why, how you own your gold matters just as much as whether you own gold. And this is where I want to take a quick moment to talk about something that could be incredibly relevant for many of you watching this. If you're sitting on retirement accounts, IRAs, 401ks with $100,000 or more, there's a strategy that allows you to get physical gold into those accounts without triggering taxes or penalties. It's called a gold IRA, and I've put together a comprehensive guide that explains exactly how it works. You'll find it in the description below. It covers the mechanics, the rules, the potential benefits, and the things you need to watch out for. If you're serious about protecting your retirement wealth from what's coming, it's worth taking a few minutes to understand this option. No obligation, just education. Check it out when we're done here. Now, let me get back to what's happening in the market and why this matters so much right now. One of the most significant developments that's not getting enough attention is what's happening with the BRICS nations. Brazil, Russia, India, China, South Africa, and now a growing list of other countries that are joining or seeking to join this bloc. These nations represent nearly half of the world's population and a massive chunk of global GDP, and they're actively working on creating alternative payment systems that bypass the dollar. Why does this matter for gold? Because every one of these initiatives, every new payment system, every bilateral trade agreement that settles in local currencies instead of dollars reduces global demand for dollars. And when demand for dollars falls, the value of dollars falls. And when the value of dollars falls, the price of gold in dollar terms rises. It's that simple. But it's not just about the BRICS. Look at what's happening in the Middle East. Saudi Arabia, the cornerstone of the petrodollar system for the past 50 years, is now accepting payment for oil in currencies other than dollars. They're in talks with China about yuan-denominated oil sales. They're exploring digital currency options. The petrodollar, the system that has underpinned dollar dominance since the 1970s, is being dismantled piece by piece. Each of these developments individually might seem small, but when you add them all up, when you see the pattern, it becomes clear that we're witnessing a fundamental restructuring of the global monetary order. And in that restructuring, gold is reasserting its role as the ultimate form of money, the one asset that every central bank, every government, every serious institution recognizes as having intrinsic value. Let me tell you a story that illustrates this perfectly. A few years ago, Germany decided it wanted to repatriate its gold reserves that were being stored in New York and Paris. This was gold that belonged to Germany, stored in foreign vaults for historical reasons dating back to the Cold War. Germany asked for its gold back. And you know what happened? It took 7 years to complete the repatriation. 7 years to return gold that supposedly was just sitting in a vault waiting to be picked up. Why did it take so long? The official explanation was logistics and security. But many analysts believe the real reason was that the gold wasn't actually there in the form that was claimed. It had been leased out or pledged as collateral or otherwise encumbered. The vaults had to scramble to source the physical metal to fulfill Germany's request. This is the kind of thing that happens when you have a fractional reserve system for gold, just like we have a fractional reserve system for banking. And this brings me to a critical point about owning gold bars. Where your gold is stored matters enormously. If your gold is in a bank safety deposit box, you need to understand that in a crisis, banks can be closed, access can be restricted, and safety deposit boxes can be seized under various legal pretexts. If your gold is in an allocated storage facility, you need to make sure it's truly allocated and segregated, not just pooled with other people's gold. And if your gold is in your personal possession, you need to have proper security measures in place. The point is, owning gold is not a passive investment. It requires thought, planning, and active management of the risks involved. But for those who do it right, the rewards can be extraordinary. Now let's talk about what's likely to happen next in this market. Based on the technical patterns, the fundamental drivers, and the historical precedents, we're likely entering a phase where gold makes a series of explosive moves higher, punctuated by sharp but brief corrections. This is classic bull market behavior in commodities. The trend is up, but the path is volatile. What triggers these explosive moves? Usually it's a combination of factors. A geopolitical event that shakes confidence in paper currencies, a central bank announcement that signals more money printing, a default or near default by a major financial institution, a breakdown in the derivatives market. Any of these could be the spark that sends gold surging. And here's what you need to understand about these moves. They happen fast, faster than most people can react. By the time the mainstream media is reporting on gold's surge, by the time your neighbor is asking you about buying gold, the big move has already happened. The people who profit are the ones who position themselves before the move, not the ones who chase it after it's already underway. This is why I keep emphasizing the importance of understanding the macro picture. If you understand why gold is going up, if you understand the fundamental forces at work, you won't be shaken out by the volatility. You won't panic sell when gold drops 10% in a week. You'll recognize those drops for what they are, temporary corrections in a much larger uptrend, and potentially opportunities to add to your position. Let me give you another historical example. In 2011, gold reached what was then an all-time high of around $1,900 per ounce. Then it entered a brutal bear market that lasted several years, eventually bottoming around $1,200. A lot of people who bought at the top got discouraged and sold at a loss. But the smart money, the people who understood the fundamentals, used that period to accumulate more physical metal at lower prices. And now, those same people are sitting on massive gains, as gold has not only recovered, but blown past those old highs. The lesson? Bull markets in gold are not straight lines up. They're volatile, they're emotional, and they test your conviction. But if you have the right perspective, if you understand what you own and why you own it, you can navigate that volatility and come out far ahead. Now, I want to address something that I know is on a lot of people's minds. What about silver? We mentioned earlier that silver just broke through $90 per ounce. Is silver a better opportunity than gold at this point? Here's my take. Silver and gold serve different purposes in a portfolio. Gold is pure monetary insurance. It's what you own to preserve wealth across generations, to protect against currency debasement, to have a form of money that no government can print. Silver has those same properties, but it also has significant industrial demand. It's used in solar panels, electronics, medical applications, and countless other industrial processes. This dual nature makes silver more volatile than gold, both on the upside and the downside. Right now, with silver at these elevated levels, we're seeing the market price in both the monetary premium and the industrial demand story. The solar industry alone is consuming massive amounts of silver, and that demand is only going to increase as the world pushes toward renewable energy. At the same time, silver is benefiting from the same monetary factors that are driving gold higher. My view is that both metals have a place in a well-structured precious metals portfolio. Gold is your foundation, your core holding. Silver is your leverage play, the position that can deliver outsized returns but with higher volatility. The ratio between the two, how many ounces of silver it takes to buy 1 ounce of gold, is also something worth watching. Historically, when that ratio gets extreme in either direction, it signals opportunities to rebalance between the two metals. But here's what I want you to really focus on. Whether you own gold bars, silver bars, or a combination of both, the most important thing is that you own physical metal, not paper promises, not ETFs that claim to be backed by metal, but might not actually have it, not mining stocks that give you exposure to the price, but also expose you to company-specific risks. Physical metal that you can hold, that you control, that no one can take away from you with the click of a mouse. Because at the end of the day, that's what this is all about. Control, independence, the ability to preserve your wealth outside of a financial system that is increasingly fragile, increasingly manipulated, and increasingly risky for ordinary people. Let me paint you a picture of what I think is coming over the next few years. I believe we're going to see gold continue to make new all-time highs, not just once or twice, but repeatedly. I think we're going to see periods where gold gains 20, 30, even 40% in a matter of months. I think we're going to see the mainstream financial media finally capitulate and start recommending gold right around the time when the easy gains have already been made. And I think we're going to see a growing divide between people who own physical precious metals and people who don't. The people who own physical metal are going to see their purchasing power preserved and potentially enhanced. The people who don't are going to see their savings eroded by inflation, their retirement accounts decimated by market volatility, and their financial security threatened by forces beyond their control. This isn't fear-mongering. This is pattern recognition. This is understanding history and applying those lessons to the current environment. Every major currency crisis in history has followed a similar pattern: excessive debt, money printing, loss of confidence, and ultimately a repricing of real assets versus paper assets. We're in the middle of that process right now. The only question is how far it goes and how fast it happens. Now, I want to be clear about something. I'm not saying you should put all your wealth into gold bars. That would be foolish. Diversification is important. You need liquidity. You need income-producing assets. You need a balanced approach to wealth preservation. But I am saying that if you don't have a meaningful allocation to physical precious metals at this point, you're taking a massive risk with your financial future. Think about it this way. What's the downside of owning gold? In a worst-case scenario, where everything I'm talking about is wrong, where the dollar remains strong, where inflation stays low, where the financial system remains stable, you own an asset that has held its value for thousands of years. You might not make spectacular returns, but you're not going to zero. You're not going to wake up one day and find out your gold is worthless. Now compare that to the downside of not owning gold. If even half of what I'm describing comes to pass, if we see significant dollar devaluation, if we see a crisis in the bond market, if we see a breakdown in the derivatives market, the people without gold are going to see their wealth evaporate. Their dollars will buy less and less. Their bonds will default or be inflated away. Their stocks will crash as the financial system seizes up. Which risk would you rather take? For those of you who've watched this far, I want to make sure you know about something special. If you're an American retiree with at least $100,000 in any retirement account, and you check out that free guide in the description, you'll also get access to an exclusive one-on-one educational web conference. No obligation, no sales pressure, just a chance to have your specific questions answered by someone who understands this market inside and out. It's only available to people who mention they watched this video, so make sure you do that when you reach out. Let me wrap this up by bringing it all together. If you own gold bars right now, you're in a position that most people will wish they were in a few years from now. You've already made the hardest decision, which is to step outside the conventional financial system and take control of your own wealth preservation. But owning gold is not a one-time decision. It's an ongoing process of education, vigilance, and strategic thinking. Stay informed about what's happening in the global monetary system. Watch what central banks are doing, not what they're saying. Pay attention to the physical market, not just the paper price. Understand the difference between real demand and speculative froth. And most importantly, have a plan for different scenarios. What will you do if gold doubles from here? Will you take some profits, or will you hold for even bigger gains? What will you do if gold drops 20% in a correction? Will you panic sell, or will you see it as a buying opportunity? These are questions you need to answer now, before the emotions of a volatile market cloud your judgment. The gold market is entering a phase that we haven't seen in decades. The forces at work are powerful, they're global, and they're accelerating. The central banks know it. The big institutions know it. The question is, do you know it? And more importantly, are you positioned to benefit from it? If you own gold bars, you're already ahead of the game. But make sure you understand what you own, why you own it, and what it means for your financial future. Because this isn't just about making money. This is about preserving wealth across what could be one of the most turbulent periods in modern financial history. This is about having real assets when paper assets fail. This is about being on the right side of the greatest wealth transfer of our generation. The news that affects gold bar owners isn't just about price movements or market trends. It's about the fundamental restructuring of the global monetary system. It's about the end of dollar dominance and the return of gold as the ultimate form of money. It's about being prepared for a future that most people can't even imagine. You've made the right choice by owning physical gold. Now make sure you're making the most of that choice by staying informed, staying strategic, and staying committed to the long-term vision of wealth preservation. Because the people who understand what's happening right now, the people who position themselves correctly, are going to look back on this period as the opportunity of a lifetime. Make sure you're one of them,